Good day, ladies and gentlemen, and welcome to the Softrax Executive Webcast Conference Call. My name is Jerry, and I will be your coordinator for today. At this time, all participants are in listen-only mode. If at any time during the call you require assistance, please press star followed by 0, and a coordinator will be happy to assist you. I would now like to turn the presentation over to your host for today's call, Mr. Bob O'Connor, President and CEO of Softrax Corporation. Please proceed.
Thank you very much, and welcome everyone to today's webcast. As you may know, Softrax is a leading provider of revenue management solutions to hundreds of companies, many of whom join us on our webcast today, so welcome to our customers. We do have over 1,000 registrants for this webcast, which indicate how much executives want to hear about today's topic from our distinguished speaker, Dr. Tony Sondhi, who's backed by popular demand to make his presentation entitled Linkage of Contracts, U.S. GAAP versus IFRS. And this is really the next installment of the series that Tony has presented throughout the year. And welcome back, Tony. And as always, Tony will be available for questions at the conclusion of his prepared remarks. I just want to take you through a little bit of the agenda. I'll spend just a few minutes on Softrax and how we play into today's topic, and then I'll turn the reins over to Tony, who will share his presentation as outlined on the screen in front of you. And for those of you who are unfamiliar with our webcast format, we do leave some time at the conclusion of Tony's presentation to answer your questions, and we'll talk about how to do that in a minute. And all this will be done by the top of the hour. To ask questions anytime during Tony's presentation, just look on your screen and look for the Ask a Question feature. Click on that and type your question in. I will be reading those questions throughout Tony's presentation, and we'll ask them, as many of as we can fit in, of him at the conclusion of his presentation. The most commonly asked question, and we already have it, submitted by one of our guests, is, can I get a copy of the slides? And the answer is yes, but we do make you work a little to get a copy of the slides. At the conclusion of the webcast, your browser will automatically be directed to a short survey. It takes about a minute. It's very important for us to get your feedback, and with it comes a slew of things. You'll get this availability of the slides. You'll get a link for a on-demand recording of this if you would like to hear it again or share with a colleague. You'll need that to get a CPE credit, which people get one CPE credit for attending. So you need to do that for the survey. And then 10 lucky attendees will also get a free copy of a very large book entitled The 2008 Revenue Recognition Guide. We can do that because Tony is the author of that book. So that's very important for us to get your feedback, to get the copy of the slides, the recording, the CPE credit, and 10 of you will get a very large book on revenue recognition. So enough for the housekeeping. Let me just take you through some information on Softrax and why we're doing this today with Tony. We develop enterprise software that manage all aspects of many companies' revenue cycle. And throughout the U.S. and throughout the world, hundreds of companies from many different industries use our software to manage their complex billing, revenue recognition, revenue reporting, revenue forecasting. And as you may know, we started the company by serving the complex revenue needs of the software industry, and we're the clear leader in that market. And as you can see here, we have grown to address the complex revenue needs of many different industries. So we are really dedicated to revenue accuracy and revenue systems for our customers because it really is so important to them. And let's just take a look at a few surveys that substantiate the importance of revenue accuracy. Studies conducted by RevenueRecognition.com and IDC provide a lot of useful information. I encourage you to visit RevenueRecognition.com to see the full studies, as well as thank you for participating in future studies. In one study, it was found that 92% of public companies are using spreadsheets for critical revenue recognition and management of critical revenue recognition issues, and clearly we know that that has led to material weaknesses, compliance issues, and scalability issues. And the reasons that we see such widespread use of manual processes and spreadsheets, again, more studies, and again, these studies are available at the websites. Really, people say that it's really too complex to manage. Revenue is very complicated, and certain business models and transaction types and volumes of data all lead to a great deal of complexity in terms of managing revenue. And in many studies, revenue recognition comes on top in terms of the area that most difficult to establish internal controls. ERP applications really don't handle, don't provide the functionality. Therefore, people are forced to use manual systems and so forth to fill in those gaps. And when they do so, certainly the impact can be very significant, as studies show that there are high compliance risk and restatement risk, a lot of opportunity for errors and real errors of great materiality, delays in being able to close in time. We find that more than half of public companies can't finalize their revenue numbers because of the complexity of their transactions and the unavailability of information, and also a real lack of information, and people are making broad assumptions with regard to revenue forecasting as they look at their bookings and sales numbers. So, and again, I encourage you to visit revenuerecognition.com for these studies. And lastly, in another study, this one by Audit and Analytics, it was found that revenue recognition restatements wipe out on average about 10% of a company's market value. And this is a study based on almost 700 restatements from 600 companies over the past couple of years. So that's certainly an area to pay attention to. Let's take a look at the operational challenges that CFOs, controllers, and other financial professionals face. There really has been a proliferation of business models, and we deal with many companies that have a variety of business models, whether they're licensing software or whether they're delivering on demand, or whether there's a transaction-based business or a hosted-based business, or real variety of business models and real proliferation of complexity of these business models. And at the same time, have to deal with the revenue recognition guidelines, and Tony will spend certainly a good deal of time on that, and their ever-increasing complexity there, as well as these people are under pressure to improve their financial reporting and visibility. However, we do see many companies who are trying to address these challenges with a host of disconnected manual or custom systems that create significant problems when one is trying to scale a company throughout the world or integrate acquired companies. And certainly the effect, in addition to the strategic value, taking a disconnected or manual or custom approach has dramatic impact on companies' performance, including cash flow, profitability, operating efficiency, and otherwise. Our applications are closely aligned with the previously mentioned challenges that companies are facing. We have billing and operation applications that manage things such as contract management, renewals, and complex billing and order management, really unparalleled revenue recognition functionality, and analytical applications that help improve visibility to help make the appropriate strategic decisions for management. And all this functionality can be delivered individually or licensed really in two major product offerings. The first here being a complete billing and revenue management applications based on industry, as you can see there, from software to SaaS to business services and so forth. And for larger enterprises who have already implemented an ERP application, name brands on the screen there, our Revenue Manager application is the most robust application and is very complementary to these existing ERP systems, and provides, again, unparalleled revenue recognition, allocation, scheduling, forecasting for booked and forecasted business. So we're happy to spend more time with you if you're interested in those. So our mission in life at Softrax is to help our customers increase their revenue, reduce their operating cost, and all the while complying with all of the revenue recognition guidelines and other regulations that we're all forced to comply with in today's environment. So I'm delighted to welcome back Tony Sondhi, a regular on these programs, and obviously, Tony, people can't get enough of you given the fact that we have well over 1,000 people in the last week of August. So certainly says a lot about how much people want to hear from you. Tony is currently a member of the Emerging Issues Task Force, EITF, of the Financial Accounting Standards Board, FASB, its Agenda Committee, and its 2008 Working Group on EITF 0801. He's also a member of the Expert Advisory Panel on Fair Value of the International Accounting Standards Board. Tony's also an advisor to the FASB on his project comparing U.S. and international financial reporting standards. As I mentioned earlier, Tony is a co-author of the 2006 to 2009 editions of the Revenue Recognition Guide. Again, we'll be giving 10 copies away, and the Analysis and Use of Financial Statements, 3rd edition. So that's just a very small portion of his bio, but in the interest of time, Tony, welcome back. It's always a pleasure to have you.
Thank you, Bob. take a look at the topic that we have today, and that's linkage. The fundamental point, I guess, or the issue here is under what circumstances would you combine two or more contracts? So the real question, in a sense, that you're asking is, and this is something critical from a revenue recognition perspective, because the basic question you're asking yourself is, what is the unit of account? And that's what we're going to talk about today. And I'm going to take you through what U.S. GAAP says about it, both in terms of the accounting standards as well as some of the implementation guidance that comes from the technical practice aids that were issued for, or as an addendum, if you wish, to SOP 97-2 and 98-9 on accounting for software. Now, at the same time, we're obviously also going to take a look at what the International Accounting Standards Board has done, beginning with IAS 11, which is on contract accounting, and then IAS 18, which is the general revenue recognition standard that the IASB has. Now, we're also going to take a look at the linkage project, which the IFRIC, and the IFRIC, as many of you, if not everyone on this call knows, is the international equivalent of the EITF. The IFRIC has spent a little more than 3 years working on linkage, and ultimately decided not to go ahead and issue anything on linkage. So we'll take a look at that, and that, in a sense, that should give you an idea of how critical this is. People have spent a lot of time. A lot of different constituents have asked the FASB to take a look at linkage, but at the moment we don't have anything beyond what you will find in the contract accounting literature, and then in that one instance you'll see in SOP 97-2. Now, there are a couple of other accounting standards where this shows up with respect to linkage, and I'm going to point those out as well. There are some different reasons at times why the FASB did decide to take a look at it, and then there are times when they decided not to go any further than pointing people back to, say, the basic literature that we're going to take a look at. Now, so let's begin with the fundamental principle, and that is both SOP 81-1, the contract accounting standard in the U.S., as well as IAS 11, which is the contract accounting standard in the International Accounting Standards, both of them have as a presumption that the unit of account is an individual contract. The IAS 11 goes on to actually reference, or just simply state, I guess I could say, that it's the contract to construct an individual asset that would be your unit of account. So what do we mean by unit of account? Basically, revenue recognition, cost accumulation, and income measurement. All of that, in other words, what we do in financial reporting with respect to contracts, all of that is to be based on the unit of account, which makes the unit of account and the proper definition of that very critical. Now, please keep in mind that 81-1, and specifically in paragraph 34 and then in 35, it goes on to say that you must focus on the terms and conditions of the contract and this is, I think, quite interesting, management intent in making your determination or coming to your decision with respect to either combining or segmenting, separating contracts. So please keep that in mind, that 81-1 says that there's a fair amount of judgment involved. So in that sense, I think of the 81-1 linkage principles, combination segmenting principles, as being a broader sort of accounting standard than we normally find. It's only when you get to the software revenue recognition that you actually find implementation guidance in the form of a technical practice aid. But 81-1 is a much broader type of argument. Keep that in mind as we go through this. Now, in 81-1, there is also an argument or a presumption, if you wish, that if revenue and profit are earned uniformly over a contract, then your financial reporting ought to reflect that as well. So in terms of the amount and timing of revenue recognition, you should recognize, in other words, give effect to that also on a uniform basis. In other words, mirror the actual earning or delivery of performance in your financial statements. Now, specifically in 81-1, linkage is discussed, combination, if you wish, is discussed in paragraphs 37 and 38. And now I understand that 81-1 has been around quite a while, and as those of you who attended my seminars will probably recall, I'm fond of saying that it was probably issued about a week after Columbus landed. So it's been around for a while. Now, what 81-1 tells us, as I said before, is that the unit of account is actually an individual contract. But there are conditions under which the standard allows that you would effectively either aggregate, in other words, combine two or more contracts, or in some cases separate an individual contract into two or more units of account in order to arrive at the appropriate revenue recognition. Now, what 81-1 gives us is 4 criteria. Now, what I want you to do is think about this. There are 2 things that I'm going to mention here before I get into the 4 criteria. The first one is think about whether the standard says that you have to meet all 4 criteria, or is it the preponderance of evidence? That is, what do your answers to or your analysis of most of these questions tell you to do? Right, so keep that in mind. And then the second thing is I'm actually going to use a very brief example and see if you can, just follow that through, and we'll see how this applies. So my basic example is this. Let's say that you enter into a contract with the town library, and the town library has asked you to take their 3x5 cards and effectively put them into, sort of a computerized system, so that there's a database, and the library's patrons can effectively come in, take a look at different monitors, computers that are, say, set out within the library, and then look up a particular book if they want. So, if you're interested in mysteries, you type in Michael Dibdin, and it tells you about all of his murder mysteries that are set in Italy, for example. And that sort of thing can be done rather than looking through 3x5 cards. So you begin work on it, and after a few months, now this is where, depending on what you want to do, I would recommend thinking about it as, let's say, it's within a short period of time or a fair amount of time passes before the library contacts you and says, okay, we're satisfied with your progress, but we've decided that we'd like you to connect the database that you're developing to, let's say, a system that will allow the library to monitor the borrowing of books, and then at the end of 2 weeks, which is a normal amount of time permitted, there should be the ability to send out automatically an email reminding the borrower that 2 weeks are up and the book is due back, and also telling the borrower, what the fees will be in the event that there's a further delay in turning the book in. So keep that in mind when the question is whether you should account for these 2 contracts together. The first one being converting the 3x5 cards into a database, electronic database, and then second, connecting effectively that database to the books that are borrowed, and then allowing the library that ability to send out or automatically sending out a notice of when the book is due, how late it is, what the fees are, and so on. Now, so what are the criteria that 81-1 tells us about? Note that the first thing is, were the two or more contracts, were they negotiated in a similar economic environment? Now here, this is mostly a timing question. The rationale being that if a significant period lapses between signing or agreeing to one contract and then agreeing to another, maybe economic conditions have changed and pricing, etc., may have changed. The second question is, what's the relationship between the two contracts? Is it really a single, sort of if you think about the IAS 11 construction, are you really talking about constructing a single asset? Now, if you think about it, let's go back for a moment to my library example. Notice that, I said you should think about whether you agree or negotiate these two contracts within a very short period of time. Right? It's just a month or 2 months or something like that. It gets harder, you'll see, to say that there's a substantive difference between the economic environments. But you take that, stretch that length of that time interval further, you might get to a point where you could say that there are clearly two different economic environments. Now, with respect to the relationship between the contracts, you'll see when you think about it for a moment that I've set them up such that it's not all that straightforward. You see, what's interesting here is that the first contract, which calls for developing the database, stands on its own. No question, it's worthwhile, that provides value to the library, to its patrons, etc., but you don't need to do anything else. The second one, however, the second contract, you can't do that without having the database, right? Because you need to know what all the books are and so on, so maybe in that sense you could argue that. Of course, you might also say that it's possible to develop the second contract such that all it does is records when a book is borrowed, gives you a reminder 14 days later, and sends off an email saying the book is now due. That sort of thing. So keep that in mind. Now, there are two other criteria. The third one, has to do with the substance and the composition of the contract. And this goes back to, is it the same asset in a way? What are the differences? And in a sense, 81-1 talks about it both in terms of inputs, which is, are there common costs that you could not separate and attach to each individual contract? In terms of output, it says, what is it that you get? What are the different activities involved? So keep that in mind. It's asking what's involved in the activities that you have to perform, the delivery that you have to give, the value that you provide to the customer. And then finally, the fourth criterion is there in substance a single customer? Now, if you think back to our library, clearly it's a single customer, it's a library. But please keep in mind, this doesn't mean that you can't have two or more contracts with a single customer. Clearly you can. I mean, there are times when, you get a customer, you'd like to sell them your entire suite of products if you could. So in that sense, all it's saying is that if there's a single customer, then some of the other criteria may suggest something more than just two different contracts and so on. So that's an important issue to keep in mind as well. Now, 81-1 does answer the question that I asked you to think about earlier, and that is it the preponderance of evidence, or do you have to have a yes or no answer to all four criteria? And this is where 81-1 tells us that for construction of production type contracts, you may combine them if the answer to each of the preceding questions is yes. Now, but it does go on to say that construction type contracts, however, may not be combined if the answer to any one of the four questions is no. So in that sense, it seems to be leaning towards an all or nothing type of approach. But then I'll remind you of what slide 2 told us, that the standard does say that you have to think about the terms and conditions and management intent and so on. So although it says so here, please keep in mind it also has told us to begin the whole debate. It informed us that it wants you, the user, to think about the terms and conditions and so on. Now, production type contracts, as different from or contrast to the construction type contracts that I just mentioned, the 81-1 tells us that you may still combine for cost accumulation and cost allocation purposes, even if the answer is no, so long as 2 additional criteria are satisfied. One, that the contracts are calling for concurrent or sequential production of substantially identical units of the product. And then finally, the second one, it says that you're using the percentage of completion method. Now, please keep in mind that when you first look at it, you might say, hey, if there's concurrent and sequential production and I'm using percentage of completion, what difference does it make? Well, it may be a function of whether you're using output or input to establish the percentage completed at any given point in time. There might also be an issue of when the costs are incurred and which ones can be recognized and so on. So it's not as straightforward as it appears. Now, please keep in mind that the 81-1 does tell us conditions under which contracts may have to be separated and they may be segmented. Again, the rationale here, the principle underlying this is if it better reflects the economics of the transaction, then you should segment them. Or similarly, if it better reflects the economics, you should combine 2 or more contracts. So it's the same thing. Now, please keep in mind that we do have an accounting standard. I could say much maligned or disliked, which is EITF 0021. But then what 21 tells you is how to separate 2 or more deliverables, and then it talks about both the measurement and the allocation of the total arrangement consideration to each of those elements that you've been able to separate. It goes on to tell you that if you can't separate them, then you would have to now keep combining them until you get to a point where you can separate. The important thing to keep in mind about EITF 0021 is that it does have, as I said, separation and allocation guidance, but you can only use it when higher level literature does not have those, either the separation and or the allocation guidance. Now, it turns out that 81-1 does have separation allocation guidance. However, SOP 81-1 only applies to deliverables that are within its scope. Now, please keep in mind, 81-1 actually has a very limited scope. So if you end up with a transaction which has both 81-1 and non-81-1 elements, then you're first going to use 0021 to separate the 81-1 elements from the non-81-1 elements. Now, please keep in mind that at the EITF, we're currently working on 0801, issue 0801, and in that issue, one of the most important things that we will address has to do with this separation allocation criteria in 0021. Our next meeting is on the 10th of September, and I recommend that you take a look at the materials once they're made available. You know they're posted to the FASB website, which is www.fasb.org. So please keep an eye open for that, and make sure that you follow along, because there's a potential for making some significant changes within 081. Okay? Now, let's take a look at what IAS 11 and IAS 18 tell us. So far I've given you a sense of what you can get from SOP 81-1. Now, please note I haven't yet gotten into Technical Practice 839, which I will in a few minutes. Now, IAS 11 talks about the conditions under which you should separate, right? That is, and it's very interesting to see this, in case you haven't looked at this before. Separate proposals have been submitted for each asset, or each separate each contract, and each asset was subject to separate negotiation. And please note this very carefully. Both the customer and the contractor have the ability to accept or reject individual components. And then finally, the third criterion is that the costs and revenues of each asset can be identified. In other words, the same separability criterion that we just looked at under 81-1 with respect to the costs. Now, the 11 also tells us about when a group of contracts should be combined. The previous slide was when they should be separated. Now, here it says that separate contracts were negotiated as a single package. Now, by this, I would go back and think about the similar economic environment argument. But notice the second criterion under IAS 11 is that the contracts are highly interrelated. Now, this is where IAS 11 comes back with having an overall profit margin. It's the same principle as was cited, or stated rather, I should say, in SOP 81-1. What is the meaning of the same overall profit margin? I think the concern here is that if you were to segregate, two or more contracts which were effectively a single contract, there's an effect on both the amount and timing of revenue recognition such that individual periods might be misstated because two or more contracts actually ought to have been combined because that's how they were actually executed. Now, please keep in mind the third criterion here, the contracts are performed concurrently or in a continuous sequence. You might recall this from the production type contracts that I just mentioned in 81-1 as well. Now, IAS 11 goes on to tell us about the conditions under which options and additions or amendments to a contract ought to be separated. And it gives us two criteria, and it talks about a fundamental or substantive difference between what performance is required under the option and what was required under the initial contract. So it says that if there's a substantive difference in design, technology, or function in what you're required to do in the option relative to what you were required in the original contract, then you ought to separate them. And second condition is that the price of the option or the addition was negotiated without regard to the original contract price. Now here is a sort of a general way of talking about the economics of the two being different. I said that's an important thing to keep in mind.
Tony, if I could interrupt for a moment, I just want to remind our audience that feel free to ask questions at any time by clicking on the ask a question box, and I'm reading them as they come in. Tony, one question came in as you were just on the slide. What's the comparable U.S. requirements for these options?
Thanks. Yeah, they're fairly comparable or similar, I would say, except that maybe they're listed, there are three of them rather than two. Maybe they've detailed it a little bit. So I would recommend that the participants and listeners in here, you ought to take a look at 81-1, paragraph 64, for example, and then for change orders, it's paragraph 61. Basically, the idea is that 81-1 says you ought to separate an option if any one of three conditions are satisfied. And the first one says, does the option or the addition call for a different product or service? So this is similar to the first criterion that IAS 11 has. The second one says that the price of the option is based on different economic criteria than those underlying the original contract. In that sense, this is equivalent to the second condition that IAS 11 talks about. And then the third condition in SOP 81-1 is that the products and services are similar in the option as they are relative to the original contract, but there are significant differences in price and costs of developing or manufacturing the product, for example, or delivering the service. So there is a similarity. If you want, you can think about IAS 11 being a slightly broader statement, and whereas there's a little bit more detail in the SOP 81-1. But thanks. That's a good question. Now let's take a look at IAS 18, and this is a very broad argument that I just want to remind you of, and that is IAS 18 also talks about the need to think about segmentation or combination. And again, it says, though, the principle in 18 is you must consider the economics, the substance of the transaction. Now, the other sort of principle that IAS 18 brings up is that revenue recognition ought to reflect the commercial effect of the transaction or a series of transactions. So the idea is, what are the terms and conditions? What's the intent underlying the contract? You might recall that this is basically what 81-1 talks about, or if you go back to concept statements 5 and 6, which are the general principles in revenue recognition, there are similar arguments in there as well. Now, I did want to, as I told you earlier, point out Technical Practice Aid 5139, and for those of you, I'm sure everybody listening in knows about this, but you should go back and take a look, if you haven't done so already, at the technical practice aids that the ACSEC issued in order to provide implementation guidance for SOP 97-2. Now, Technical Practice Aid 5139 gives us 6 criteria, and then there's a 7th one in here, and I'll tell you about that in just a second. Now, the first one looks at the timing of the execution of the contract. In other words, we're looking at whether they're in a similar economic environment, just as IAS 11 and 81-1. So the contracts or agreements were negotiated within a short period of time. Now, please note here that I've said this also was discussed in 133, the accounting standard on derivatives. There, you'll recall the FASB wants all derivatives measured at and reported at fair value, and they want the changes in fair value either in the income statement or in other comprehensive income. So effectively what they want to do is they did not want to allow companies to break up a contract into 2 or more pieces and avoid the fair value requirement. And that's why 133 Guide, or DIG, question K1 talks about this. The definition of the customer, you'll recall this is the same as both 81-1 and 11. If they are for the same customer or affiliated entities. There's a little bit more over here because neither of those 2 standards talked about affiliated entities. Now, there are 3 criteria that spell out the meaning of substance and composition of the contract, which was the broad principle stated in 81-1 and IAS 11. In Technical Practice Aid 39, it says, determine whether the contract relates to the same elements, or is it a single project. Second, it says, is there any relationship between the different deliverables? Does one deliverable provide value to the customer only if something else has been delivered, another element? And finally, what's the relationship in terms of design, technology, and function? You'll recall this is one of the arguments in IAS 11. Then, there are 2 criteria that discuss the consideration. And in a sense, these 2 criteria sort of expand the principles that were discussed or provided in 81-1 and 11. Because here it says, is there a relationship between the 2 contracts such that unsatisfactory performance on one will result in a refund, a concession, or something with respect to another? And is there any relationship between the payment terms? Do they coincide? So payment on contract 2 or 1 will only be made after the second contract is delivered. Then you're going to have a problem. So that's what Technical Practice 850-139 tells us. So just as you would think, an implementation guidance, as this one is, would normally tell you a little bit more than the basic principles that you would find in an accounting standard. Now, I also, as I said, wanted to tell you a little bit about the linkage project, and I'm mindful because I do want to leave a few moments for the questions. The IFRIC, as I said, undertook a project. It began in 2002, and what they initially thought about was how to take that substance and commercial effect principle along with the requirement to evaluate all terms and conditions and the different rights and obligations to determine when 2 or more contracts ought to be combined. In 2003, they effectively, sorry about the pun, but the linkage product was linked with the IFRIC project. That IFRIC project was linked on IAS 11. So basically they said, instead of looking at IAS 11 projects separately, let's look at both of these. They developed an interpretation to provide additional guidance, reminded people that IAS 18 already asks you to look to IAS 11 for guidance on combining and segmentation. So instead of coming up with any new standards, they said we already have something in IAS 11, it applies elsewhere. Now, of course, they also then, IFRIC noted that in the event they came up with something different, they'd have to go back and amend IAS 11. Now, in the meantime, the IFRIC was also looking at service concessions. And they found that the guidance on linkage there would effectively also be necessary for other multiple element type of transactions. In March 2004, they looked at the multiple contracts in terms of multiple elements and decided under which conditions they ought to combine and or separate them. And you can look at these in detail. What I do want to focus on is that the board in 2004, asked the IFRIC to effectively decided to expand the project somewhat to consider whether output measures could be used to segment contracts. So in other words, looking at the value a customer receives, that's what you're effectively trying to use to determine whether you ought to segment contracts or combine them. Now, in 2005, they decided at the IFRIC that the issues are actually much broader, and that they probably needed to undertake a full-fledged review of this, and it might be better as a standard than as an IFRIC document. And therefore, finally, in 2006, in November, they decided to put it off until they had settled the revenue recognition project. Now, in order to do that, you ought to take a look at what's going on with the revenue recognition project over here in the U.S., and they're getting close in the U.S. to issuing some kind of a document. And once again, take a look at the FASB website. So let me close this portion by saying that the accounting standard on linkage, or the guidance, I should say, that we have, is somewhat fragmented. But there is a broad principle in 81-1 and in IAS 11 that I think can be used elsewhere. There are some problem areas that are pointed out. The technical practice aid sort of pushes. There are some differences with respect to options, change orders. But in a sense, I think they're similar. What's going to happen, we'll have to wait and see what the revenue recognition project brings us. So that's where I'd like to leave that. Now, I do want to point out, if you take a look at this last slide, I'll give you a sense of the seminars that I'm offering, public seminars, coming up in the next 2 or 3 months. And you'll see that I've got some sessions on revenue recognition, some focusing on software, others that are general. But please keep in mind there are some other programs as well. There's a new accounting standard in acquisition accounting, and there'll be an advanced topic seminar on that, a 2-day session. And then there's 3 days on sort of an update, the first day being devoted, and you can come to that alone, being devoted to the most critical differences between international accounting standards and U.S. GAAP, and then a 2-day FASB, EITF, IASB update type of thing. Okay? So, Bob, it's all yours.
Not for long, Tony, because we're going to go right back to you with questions. So, but you can. Thank you very much. It was very helpful. We have lots of questions, and people can continue to add more as you like, and I will try to read at the same time as I'm asking the questions. Just Tony, on this definition of a customer, and some of these questions came in, and then later on you talked about the affiliate seems to have been clarified. Because people had questions about whether they had just single customer or whether it's a large entity with selling into a large enterprise. So is the definition of affiliate entities in the on your previous slide, the question K-1, is that identified there, or can you help us in terms of definition of a customer?
Okay. Both in the 133 guide in question K1 and in Technical Practice Aid 5139, the intent was to say that the definition of a customer is broad. And particularly in derivatives, the idea was it's very clear. You can't take one piece of or one contract with a parent company and another with a subsidiary and say you've got two different customers. So in that sense, it's a very broad definition. Now, I will point you to the accounting standard on segment reporting 131. That has a good definition of a customer, and you should also take a look at the accounting standard 57 on related parties, because that'll give you a much better sense of customers. If you look at the basis for conclusions in Interpretation 46 as revised on variable interest entities, there's a little bit of a discussion there as well. But to get a sense of what the accounting standard setters mean by customer, the first thing is that it's a broad definition. And then I've given you the different sources that you can look it up further if you like.
Okay. Certainly many of our customers and other companies have a combination of products such as hardware and software, so we had some questions around that. How do you apply this combination when you're selling both hardware and software? And in some cases, the hardware is the more dominant product, and in some cases, the software is the more dominant product.
One of the most important issues that you have to ask yourself when you have both hardware and software and you're selling to the same customer is what's the relationship between those two. And even if it's not so much, or you're not going to be able to resolve it so much in terms of dominant, it's going to be more of the essential or incidental to functionality. And one of the things that's been happening lately is that although hardware continues to be a dominant portion, software is becoming a very big part of many different transactions, many contracts. The other thing I find is in the world in general, and certainly among my clients, I'm finding that people don't sell products or services. Everybody's selling a solution, which means they're selling multiple elements. And hardware, software are certainly a very common combination. So you have to think about 035, the essential to functionality rules. You have to look at footnote 2 to SOP 97-2 to look at some of the issues with respect to incidental to functionality. So it's a somewhat complex determination that you have to make, and you have to do it carefully because of how important software is becoming these days. There are certain industries where it's a little more critical. Semiconductors, medical equipment come to mind, but there are others as well.
Certainly some questions, as always, on fair value, Tony. Here's one that I think encompasses a lot of the questions. So in addition to the linkage differences, could you also discuss fair value differences, separation guidance between GAAP and IFRS?
Well, the fair value differences are probably more pronounced in the U.S. because in 97-2 you have VSOE, or Vendor-Specific Objective Evidence of fair value, and there are certain rules or principles, if whichever way you want to look at it, that attach to those. EITF 0021 talks about objective and reliable evidence of fair value, and there's always a question of whether that's supposed to be different. I've said in the past at one of these webcasts, one or more of these webcasts, that I think VSOE is probably the best type of objective and reliable evidence you can come up with. Now, in a sense, in other accounting standards, there's not much of a discussion. But we do have an accounting standard, 157, on fair value measurements, which has a definition of fair value. And it's really an exit price. So in other words, what would you get for selling an asset, or how much would you have to pay someone to settle a liability, those kinds of things. Now what's happening and this is where again I recommend that you keep an eye open on 081, because we're taking a look at that fair value issue there as well, and you must keep an eye open on the revenue recognition project, because they've also attacked the same issue. So we'll see how things change. At the moment, that's where we are. Now, you asked whether the IAS, at the International Accounting Standards, the definition of fair value in general is roughly the same. They don't actually have software accounting standards, so you don't actually have anything like a VSOE. Their comment or discussion of 0021 multiple elements is very, very general, and therefore they don't specifically say something like objective and reliable evidence. Okay?
Thank you. Tony, there was some requests for you to provide some insight with respect to service arrangements. We talked about hardware, software just now in a question, but could you also add some light in terms of service arrangements?
In terms of service arrangements, probably the first thing, as I'm sure everybody there knows, we don't actually have an accounting standard on service transactions. So what we have to do is look at Concept Statement 5, the general principles. You have to look at SAB 104, and SAB 104 does address them to some extent. And then there is the 1978 invitation to comment on service transactions, the accounting for service transactions. Now, keeping in mind that an invitation to comment, since it never became an accounting standard, it's not really an accounting standard in that sense, but since there's nothing else, you would refer to it. Now, there are arrangements that are more common, becoming more and more common these days, where you will manufacture a product or provide some software plus provide a service. And then that service, in most cases, actually does not fall into either 97-2 or 81-1, as the case may be, which then makes 0021 critical. And that's where fair value comes in. That's where the separation and allocation comes in. Service transactions are just as complex as other transactions, and one problem being that you don't have much guidance. One other thing about service transactions that I'll point out is that in general, we recognize revenue using a proportional performance model, which means revenue is recognized over time as the services are delivered. But you've got to keep in mind that although the percentage of completion method of 81-1 is a type of proportional performance, the percentage of completion method is actually a gross profit recognition method more than anything else. Service transactions, you recognize revenue according to the proportional performance model, but costs you'd end up recognizing as they're incurred. So you're going to get a very different gross profit margin there, which again creates or gives you another reason to be very careful about the accounting for service transactions.
I had some comments about, Tony, in general it seems that the IAS concepts seem to complement the TPAs and FASB guidance. Is that a true statement? And if it's not, what would be your comments on that?
I think that in this case that's a reasonable comment to make. To a large extent, IAS 11 and then 18 in effect, and what they were working on in the linkage project over at the IFRIC, those certainly did take from. In fact, if you go back and take a look at the summary of the IFRIC project, and one place you could find that would be Chapter 13 in my revenue recognition book, for example. And you can also find, maybe you can still find it on the IASB website, which is iasb.org. Now, what you'll find there is that they did talk about taking the principles from 81-1, using some of the technical practice aids. So in that sense, yes, I would agree that they're quite complementary.
Tony, taking out the crystal ball here, so we had a lot of questions about where is this all headed, and a little more specifically, as a follow-up to that, what is the timeline that you'd be thinking that would require U.S. companies to comply with IFRS? But more generally in terms of where is this headed, and then maybe some timelines.
Right. Where it is headed is going to be very much a function of the reception that the proposed revenue recognition, standard, which you should be able to see sometime this year from the FASB. Well, that's a joint project, but you'll see it from the FASB, and that'll give you a sense. That'll be our first sense of where it's headed. Now, one of the things that I can tell you where it's headed, because everybody knows this, and just so to be a reminder more than anything else, there certainly is an emphasis on the asset liability view of revenue recognition, which is very different from what we have today, because everything today is an earnings perspective. So that's a big difference. Fair value becomes pretty important because you're talking about performance obligations, liabilities. You have to measure them at fair value. So in the sense of where everything is going, we get much more information within the next 2 or 3 months. At least that's what they promise us. As to timelines, I guess the real question is, when will this all have to be changed? I can't see it being done much earlier than 2011 for the revenue recognition standard. But that's asking or assuming a very, very fast acceptance of where the standard is. And I can't say whether that's going to happen. It's very hard to do that. The other question, I suppose, is, when are we all going to be using international accounting standards? And all I can tell you is that everything I see tells me it's going to be sooner rather than later. When, you might just want to see what happens on Friday, because the SEC expects to release a document, a report that a group was asked to provide. There's a little bit of a discussion of that on revenuerecognition.com this morning. You might want to take a look at that. But other than that, I think it's very hard to say when. We're just going to have to see. But again, as I said, it's going to be sooner rather than later.
All right, great. Well, we're up against the clock. Tony, thank you very much, as always, for sharing your insight. Really hot off the presses. We really appreciate that. I know it's very valuable to people on the call today. I'd also like to thank all our guests for taking the time to attend today's event. Thank you for all of your questions, and I'm sorry we couldn't get to them all. We certainly have like 100 or so questions, so we couldn't get to them. But if you look at your screen now on revenuerecognition.com, there is a facility to ask your colleagues these questions and have people weigh in on those. So please feel free to use that form as well. Please be reminded as well that we would like your questionnaire filled out. It should only take about a minute. That gives you copies of the slides. It gives you a recording link if you'd like to share that or hear this again. It allows you to get CPE credits and certainly also gets you an opportunity to get the revenue recognition book as well. So there's the link on your screen now. So please do that because we'd like your feedback. And please stay tuned to your email as well as revrec.com and Softrax.com for future events, some of them starring Tony Sondhi, some of them having other speakers. So thank you very much, Tony. Appreciate it. And thank you to everyone. Bye-bye.